This is MarcoVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MarcoVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Now listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MarcoVoices.com. Just go to our homepage, MarcoVoices.com, and click on the red button over Louis' picture saying, looking for the downloads. Now, Eric, let's talk crude oil, starting with the EIA inventory data.
EIA posted a massive build of 5.5 million barrels of crude oil this week. The thing is, that was offset by an even bigger drawdown in finished products, with gasoline drawing down 3.1 million barrels and distillates drawing down 3.2 million barrels. So net petroleum production was actually a drawdown of 0.8 million barrels. Unfortunately, I don't have any data for Cushing, Oklahoma this week. U.S. production bounced all the way back up to 13.3 million barrels. That's an increase of 300,000 barrels over last week, and it's also a return to the previous all-time high. So we're right back up at highs in U.S. production. The concern that I had last week that it might take a few weeks to get back there turned out to be unfounded. After failing at the 100-day moving average and retesting all the way down to the 200-week lows, the market is trying to recover once again. We need to see a move back above the 77.33 200-day moving average on the continuation chart for WTI before we can say that the rally is really back on. And that's still well above the market. But things are heating up in the Red Sea and elsewhere, and it wouldn't take that much news to move this market back into a rally.
Yeah, it was a heavy sell week last week, Eric, but to me, there's a couple interesting dynamics I'm watching. First of all, when we look at gasoline futures, which tend to correlate with oil, they've now fully recovered that drop. And the question I have in my mind is that an indication that this was an overshoot on the downside on crude oil, and we'll get back above that 50-day moving average. There's two levels, a little zone between $75 and $76 where the 50-day moving average and the Fibonacci retrace zones lie. To me, this is the make it or break it pivot level. If crude oil can't beat 75, 76, and it may very well just trade to the bottom end of the trade range down around $70 and just consolidate sideways for a while. But if we see the bulls crack above that 75, 76 level, again, and consolidate up there, then the bullishness we were looking for could still be there. And we're going to find out right at this level. I don't think it's going to take more than 2 or 3 trading sessions to find out. Nonetheless, let's move on to equities. I want to get Nick involved in this conversation. Let's just start off, Nick, with what levels are you watching on the SPX?
Yeah, Patrick. So we smashed that 5,000 level yesterday, which is very, very interesting. That's a key level right now with the call wall as well. There's a put wall right now at 4,500, so well out of the money on SPX. Spot price right now as we speak is 5,000 approximately. The implied move for the February 16th OPEX, which is next Friday's OPEX, is plus minus 66 points. Therefore, the upper implied move is 5,066. And the lower implied move is 49.34. Key resistance right now is right at 5,000. Very important level. If we smash above it, it's possible we push another 50, 100 points perhaps. Key support below is at 4,900 or so. I'm inclined to think we perhaps see a little bit of an overshoot of 5,000, followed by a nice correction down to that 4,800 level roughly.
You know, Nick, it's interesting you say that. Like, obviously, this it's a huge psychological thing for the S&P to clear this 5,000 hurdle, and it certainly creates the media hype. It's going to make great headline news. The interesting part, though, to me is that the market, the S&P is not telling the real story of what's happening in U.S. equities. And so I put together on page 4 and 5 just a couple charts to look at. Obviously, S&P making new highs, but let's talk about a couple of interesting interesting little observations. When you go to the S&P 500 equal weight index, which is just market cap balancing the 500 stocks, that index has not beat its December highs, even though it does resemble a bit of an ascending triangle pattern. The other observation is the Russell 2000 is actually trading near 2-month lows. Not only did we put in that high in late December, but the bounce that happened in January was barely a 50% retracement of the sell-off, and it's now trading right back down along there, not participating at all. And so what is an interesting way to look at that is if you observe the percentage of stocks above their 50-day moving average that I put on page 5, I overlaid 3 different versions. One is looking at the S&P 500 percentage of stocks versus the NASDAQ in pink. And in light blue, we have the New York Stock Exchange market breadth. And what you can see is that the breadth of the broader NASDAQ is down to 41%. That means 6 out of 10 stocks are downtrending on the NASDAQ index. I find that fascinating considering those Mag 7 stocks are really the biggest ones, are the ones driving all the flows. But you look at it when the broader New York Stock Exchange, which includes many of those small cap stocks, was down to 52% on the breadth reading, which means that literally half of the stocks are already in a downtrend. It implies to me that when you look under the hood, under the surface of this index that's rising, the breadth deteriorating means that the foundation of the market is kind of breaking up, which makes me incredibly suspect of this rally. Now, can this S&P 500 still put on an extra 50 points, 100 points? Could we see 5,100? You can't rule it out. And the pattern of higher highs, higher lows, and accumulation is still very distinctly there, Nick. But this just to me spells that once those big leadership stocks that had these huge gaps higher have finished their upside moves and run out of momentum, then it really creates an environment that unless the breadth magically widens, that the recipe for that 300 to 500 S&P point correction will be here. There's very little asymmetry in being long this market here, while it certainly can still plug a little bit higher in the coming days.
I totally agree, Patrick. Watching these Mag 7 names keep pushing higher while the rest of the market kind of lags or declines is very, very interesting. I've been tracking these sector ETFs each and every day and noticing how XLK is consistently the top gainer while everything else lags is pretty interesting overall. For example, XBI was down about 1.5% and everything else was up yesterday, right? So looking at these Mag 7 names, we've seen NVIDIA run astronomically over the last few weeks. It's gone from 500 to 700 on no actual news. And fundamentally speaking, a company now worth almost approaching $2 trillion with revenues of about $48 billion and profits of sub $20 billion. It's insane. It's just absolute insanity to me. Even if they grow their revenues by 50% every year for the next 10 years, they still wouldn't justify the current valuation. So right now, back to the Qs again. The key levels right now are the call wall at 440. We have a put wall at 400. Spot price right now is 432. The implied move for next Friday's February 16th OPEX is plus minus 8 points. Therefore, the upper implied move is 440 and the lower implied move is 424. Key resistance right now is at 440 as well, where the call wall resides, and key support is at previous all-time highs of 410.
Yeah, and what's interesting as well, Nick, is that the NASDAQ, just even though it's the Mag 7s that are actually the leadership that's driving the S&P, and NASDAQ itself has actually not got the same momentum as the S&P. I find that divergence really interesting. Anyway, let's talk volatility. On page 7, the VIX is back to a 12 handle. We're back into the trade range that we've been in for several months now. What's your take on what's the implied moves?
So right now with the VIX at approximately 13, we can expect top to bottom moves intraday of about 0.75% roughly. Over the last few weeks, the actual implied move average is about 0.62%. So what I've noticed is that we kind of push outside that range intraday. So for example, in the morning, if we extend to, 0.9% up or down, what happens is by end of day, we usually pull back within that 0.75 or 0.62 range, which is the average of the past few weeks. I'm still seeing a lot of volatility selling on the call side, especially as we approach that 5,000 level. We're seeing a lot of call selling above, as well as put selling out of the money below. So Volatility suppression can be expected here, but again, I'm not really inclined to see much activity until we see that February OPEX pass, after which I see an expansion in volatility and some more abrupt moves perhaps in the other direction. Now moving on to page 8, we have the US dollar index. What are your thoughts here?
104 is an important technical level on the Dixie chart, and a breakout above it could signal a move much higher in the works. We had 2 daily closes above that level earlier this week, and now we're back below it. If we stay below 104 for a few more days, we can write that off as a fake breakout. But if the Dixie moves back above 104.5, that could signal another leg higher.
Eric, I'm watching the exact same levels as you. The 104 was where a lot of those previous highs were through January, but the 104.5 is a key fib zone to me. But what I find fascinating is what the underpinning levels on the cross currencies themselves, particularly today, was a significant breakout in the US dollar yen. And at the same time, the euro is trading at a very critical 107 level, which is also, in my mind, a make it or break it level. Now, while the dollar is trading above its 50-day moving averages and has actually been trending higher all year for at least the first month of January of the year, it's a scenario where we're going to get the pivot right now. If the dollar strengthens above these levels, it could very well be the catalyst for a lot of risk off, particularly in many of the commodity spaces, and maybe even the equity markets will start responding if that break happens. So it's certainly something that's on my mind and on my watch list.
Now on page 9, we have the gold futures chart. Eric, what are your thoughts here?
As I've said so many times before, I think 2024 is the year that gold will break out to new all-time highs. And the cup and handle pattern that's been forming since 2011 would target a move higher to over 2,700 after that breakout occurs. But it's all about the dollar and the timing of the Fed cuts. And frankly, I think it's impossible for anyone other than Jay Powell to know whether the Fed is serious when they say that they're probably not going to be a rate cut in March or May, or if they're just trying to contain animal spirits before moving ahead with a first cut in March. That's going to be what decides whether gold's move higher happens in early 2024 or in late 2024.
Eric, I'm also super bullish gold in the bigger picture, especially once we have a rate cut cycle get underway. But on the short term, the price action remains very choppy and in consolidation. I wouldn't be shocked here if gold had a trip back to 2000 just to retest some of the previous lows that were and highs and lows that were established throughout the last 6 months. During that kind of consolidation, I would view it all as buying opportunities. But right now, clearly gold is just not trending yet in terms of a new breakout, but I think inevitably it'll play out. The just on page 10 though, I have wanted to talk about this uranium chart, and the uranium was a perfect buy on dip. It's holding up along the highs, and I don't see any reason why this trend can't continue. This is the one commodity that seems to really be marching to the beat of its own drum. A lot of the other commodities tend to be correlated here and are stuck in the mud, and uranium continues to be hot. I wouldn't be shocked if the Sprott Physical Uranium ETF in the U.UN was trading at $35, $36 in the week to come. And finally, I wanted to just touch on page 11, just the Bloomberg High Yield Bond ETF. And one of the interesting things that we've seen is that junk bonds were incredibly strong off of that October low. And we had a big rip, but junk bonds have really stopped participating on the upside. They tend to correlate well with equities, and that correlation seems to now be kind of diverging, making high yield bonds behaving far more like the Russell in the broader market than it is like the S&P. What will be interesting to me is whether or not this ETF starts breaking below the $94 level, accompanied by a widening of the credit spreads. We haven't seen a signal from high yield bonds about a potential correction in quite a while, and so we'll see whether or not the price action starts to deteriorate here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.